Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today's Thursday, February 4th, 2010. It was a very volatile day in the markets as we had the Euro, Pound, Aussie, and other higher yielders sold off against the greenback and the Japanese yen, as investors were very anxious about festering problems in the Eurozone regarding sovereign debt, as well as a sell-off in equity markets around the globe. As you can see, we had a very sharp slide in the pair as we broke below support at 1.3850, which was our support to start the week on Monday. And following the press conference from ECB President Trichet following the European Central Bank decision, we had moved into the New York session and had a further sell-off as there were lingering concerns during the press conference about Greece's debt situation. We saw the cost to insure the debt of Eurozone members with large budget deficits against default rise in today's trading, and traders are now looking at other countries like Portugal and Spain in regards to their big budget deficits. We pushed below the 1.38 level here, and by the end of the New York session, we had hit a new 8-month low in this pair. The major stock indexes in Europe were off more than 2.5%, and the Dow Jones and other major stock indexes in the US were also down between 2 and 3%. A very sharp sell-off as it looks like traders got caught a bit flat-footed in regards to today's heavy risk aversion. In the ECB interest rate decision, bank policymakers held the benchmark interest rate at 1% and said that they would await for new growth and inflation forecasts in March before deciding when to step up the withdrawal of the emergency measures they had set up to battle the financial crisis. On the topic of Greece, ECB President Trichet did say that we expect and we are confident that the Greek government will take all the decisions that will permit them to reach that goal, as well as indicating that the ECB interest rate was appropriate. So this is pretty much a wait and see decision, and as I mentioned, the press conference following it did heavily focus on Greece and what the ECB would do about it, though ECB President Trichet didn't necessarily propose any new measures to help Greece with its troubles. While the sell-off in markets had part of the reason was the problems in the Eurozone, we did see a weaker than expected jobless claims report from the US, which hurt US stocks. Jobless claims rose to 480,000 for the week ending January 30th, while continuing claims stayed around 4.6. The thing to take away here, though, is if you could look at the circle on the chart here, that the trend in jobless claims had been declining, but then the last few weeks we see this turn back up to higher jobless claims. So we do await tomorrow's very important non-farm payroll report, but this jobless claims report definitely left a sour feeling about the direction of the US labor market. So that intensified the sell-off in equities that we had seen that started in the European session. Taking a look at the pound-dollar pair, we see that we broke below the 1.59 level in overnight trading, and then we broke below our support from Monday around 1.5850 as we approached the Bank of England interest rate decision. And following the decision, we did have a bit of a counter rally, but then as we had a sell-off in New York trading and New York equities, this pair fell in favor of the dollar as the dollar was boosted by its safe haven appeal. The Bank of England decided to keep its benchmark interest rate steady at 0.5% and also did not expand its £200 billion bond purchase program, which had run up in this meeting. The funds allocated had run up. The MPC in its statement did say that the considerable stimulus from its easing in monetary policy, the low level of the sterling, and the recovery in UK exports should help to support domestic activity going forward, but they did not rule out further quantitative easing if the UK economy dipped or fell into a double dip recession. So while they did not expand the quantitative easing program, leaving the door open for a resumption of the program made this somewhat dovish statement. Now let's take a look at some other pairs and see how they reacted in today's market. If we take a look at the dollar yen, we see that the yen was a big benefactor of the increase in risk aversion, as it is a safe haven and as a funding currency in carry trade. When there is increased risk aversion, the yen does gain. So we see that the gains we had seen in the last 5 or 6 sessions were all wiped out, and we broke below our support here around the 89 level, reaching a low for the session around 88.50. If we zoom this pair out, we see that that move extends the downward direction this pair had been taking since reaching a high around 93.35. So we did have a pretty significant rally by the greenback throughout December and parts of January, but we have now broken below the 50% retracement of that rally in today's trading. So we had support, as you can tell here, around the 89.40 level, but we plunged below that in today's trading. The euro yen, meanwhile, fell as much as 3.8% in today's trading, and if we look at how many pips that was from high to low, almost 470. So a very huge move, a huge sell-off of the euro, and with the yen being a big benefactor. So here too we had the euro sliding throughout most of late January, and following a period of consolidation where we had 127 acting as resistance, we've now had a sharp move further downward. We can see that currency markets had almost a bit of a mini meltdown as the risk aversion reverberated into and turned into a bit of a stampede out of stocks, commodities, and riskier currencies. If we look at the Australian dollar US dollar pair, we see a similar sharp decline, though here the pip value from high to low is about 200, but again, we're extending these declines in favor of the greenback, and we broke through an important level of support here around the 88 level. So that had been holding throughout this week, but now we've moved sharply lower with new support around 86. So today's market action reflects an uncertainty amongst investors about the health of the global economic recovery. If we're seeing major problems in the Eurozone in regards to some of its smaller countries' debt situation, we see that the Chinese central bank is trying to tighten its monetary policy, and if the jobless claims figures we saw are accurately reflecting a weaker U.S. labor market, then it's important to try to figure out where growth will come from. However, the U.S., if tomorrow's non-farm payroll report shows job growth, we can safely say that the U.S. recovery seems to be progressing better than some of its major rivals like the Eurozone and the UK and Japan, and so the greenback is benefiting both from better fundamentals as well as its allure as a safe haven during times of higher risk aversion. So this could be a chance for the greenback to extend its gains that it had throughout January against some of its higher yielder rivals. Now let's take a look at our upcoming fundamental events in our Friday global session. Tonight, Australia posts 3 releases: a measure of its construction sector, the Reserve Bank of Australia quarterly statement, as well as the New Zealand Bank quarterly business outlook. Overnight, Japan posts its leading indicators, while the UK releases its figures on producer price inflation, and Germany releases data on industrial production. Tomorrow, Canada releases its employment report at 7 a.m., while the U.S. posts its non-farm payroll report and unemployment rate at 8:30. So that's a really big release, and we'll see if it can help stem some of this risk aversion if it's a positive number, or accelerate it if it comes in weaker than expected. Finally, at 3 p.m., we have data on U.S. consumer credit. So that will wrap up today's fundamental market recap. I want to thank you for watching, and for more videos, news, and analysis, please do visit our site FXTimes.com. And with that, I want to wish you good trading.